Welcome back to The Explainer. Today, we're diving straight into a critical part of the month-end close for cash. We're going to follow the entire journey, starting right at the ground level with account reconciliations, all the way up to how these figures actually land in your financial reporting. Whether you're tightening up your internal controls or just making sure your workflow is totally bulletproof, this breakdown is going to give you the exact rules of the road. Let's get into it.
Here is our roadmap for mastering this workflow. We'll kick things off with the ultimate cash control, figure out how to bridge that balance gap, and walk through a two-sided reconciliation example. Then, we'll tackle the tricky rules around bank versus book overdrafts, map everything out for financial statement presentation, and finally, help you avoid what I call the cash flow trap. Okay, Section 1, the ultimate cash control. Let's prove those balances match. We're starting with the absolute bedrock of cash accounting, the bank reconciliation. This is where the rubber meets the road, right? It's the process of proving that your company's internal ledger actually matches external reality, after adjusting for valid timing differences, of course. Listen, a bank reconciliation has to be performed for every single bank account at every single period close, no exceptions. It's not just a nice-to-have for your main operating accounts. If it has your entity's name on it, you reconcile it. It's literally your primary defense against missing transactions, errors, and frankly, missing money. It ensures your financial reality perfectly aligns with the bank's reality. But here's the catch. Just doing the reconciliation isn't enough. The process itself has to be secure. And that brings us to the cardinal rule of cash controls. The preparer cannot be the reviewer. You need one person to prep the reconciliation and a completely different person to review and approve it. Think about it. A reconciliation prepared and signed off by the exact same person? That's just a piece of paper. It's a formality. It's definitely not an internal control because there's absolutely no secondary check to catch mistakes or worse, inappropriate manipulation. So always separate the preparer from the reviewer.
Moving right along to Section 2, bridging the balance gap and understanding those tricky reconciling items.
So you might be wondering, why do the books and the bank almost never match on day one of the close? I mean, if we're recording everything right, shouldn't they be identical? Well, it's all about timing. And to solve this, we use a super helpful little heuristic, who knows what. It makes the whole process so logical. Here's how it works. If only the books know about an item, like a deposit you just dropped in the mail or a check you wrote that the vendor hasn't cashed yet, the bank is totally in the dark. These are just timing differences. So no journal entry is needed. You literally just adjust the bank side on your reconciliation. But if only the bank knows about an item, say a monthly service charge, some interest they credited, or a customer's check that bounced, your books don't know about it yet. For those items, your books absolutely need a journal entry to catch up to reality.
All right, Section 3. Let's look at a two-sided reconciliation example and see how we bounce between the book and the bank.
It's one thing to talk about the theory, right? But seeing the math in action really drives the concept home. Let's look at a classic two-sided reconciliation. Notice our starting point. The books think we have $120,000, but the bank statement says $125,000. So we bounce back and forth applying our heuristic. On the bank side, we add the $8,000 deposit in transit and subtract the $12,000 in outstanding checks. Why? Because our books already know about those. Meanwhile, on the book side, we subtract the $150 service charge and the $925 non-sufficient funds check, and we add in the $75 of interest income, because the bank already processed those. And boom! By doing this, both sides adjust to a perfectly matching true balance of $119,000.
And this perfectly illustrates the golden rule of bank reconciliations. We only post journal entries for the book side adjustments. The bank has already processed the deposits in transit and outstanding checks on their end, so we don't touch our ledger for those. But for the bank charges, the interest, and that bounced NSF check, we definitely have to record them. We debit bank charges expense for $150, we debit cash to recognize our $75 of interest income, and crucially, for that $925 bounce check, we have to debit accounts receivable to put that balance right back on the customer's tab while crediting our cash.
Before we move on, I really need to emphasize a major warning here. Never, ever force a reconciliation. If you've got a $50 difference, do not just plug it into a random expense account to make the math work. Every single item must have a specific name and a valid explanation. Plus, any outstanding items, like uncashed checks, that are lingering for over 60 to 90 days, those need to be escalated. Stale items aren't just messy bookkeeping. They could indicate unrecorded transactions, lost checks, or, in worst-case scenarios, active fraud.
Okay, Section 4. Let's talk about bank versus book overdrafts and how to handle balance anomalies.
Now that our accounts are perfectly reconciled, what happens when things go a bit sideways? Specifically, when balances dip below zero. It's so critical to understand the distinction between the two types of overdrafts because US GAAP is incredibly strict about them. A bank overdraft is straightforward. Your actual bank account is overdrawn. It's literally negative. But a book overdraft is a bit trickier. This is when your bank balance is actually positive, but you've written so many outstanding checks that your internal accounting ledger has dropped below zero. The absolute vital takeaway here? Both a true bank overdraft and a book overdraft caused by uncashed checks must be reclassified as a current liability before you finalize your balance sheet. You simply cannot report negative cash. Period.
But wait, what if you have multiple accounts? Can you net an overdraft against a positive cash balance? Let's break down exactly when you can and can't do this. If you only have one account at Bank A and it's overdrawn, it's a current liability. Easy. Now, if you have an overdrawn account at Bank A, but a nice positive account at Bank B, well, they are different legal entities. You cannot net them. That overdraft is still a current liability. Under US GAAP, you can only offset an overdraft if you have a positive balance at the exact same banking institution, and this is the absolutely critical part, you must have a formally documented legal right of offset in your account agreement. No documentation, no netting.
Moving into Section 5, Financial Statement Presentation. Let's build those outputs. With our cash balances locked in, reconciled, and our overdrafts properly classified, we're finally ready to take these numbers and populate the financial statements. Let's look at the balance sheet first. The rules here are highly standardized. Unrestricted cash proudly takes line 1 in current assets. However, if you have restricted cash, say a required deposit for a lease or maybe a loan covenant, it gets carved out onto separate lines. If that restriction lifts within 12 months, it's a current asset. If the restriction lasts beyond 12 months, it's a non-current asset. And, like we just talked about, any bank overdrafts sit securely right down in current liabilities.
Now, over on your income statement, you're picking up the specific activities we just posted journal entries for during our reconciliation. That interest you earned drops right into interest income. Your bank service fees, those hit bank charges expense. If you're dealing with foreign bank accounts, the foreign exchange remeasurements at the closing rate are routed to other income or expense. And if you have a physical petty cash box that came up, say, $5 short during the count, that difference hits a specific cash over short expense line.
Finally, Section 6, the cash flow trap and ASU 2016-18 requirements.
Let's turn to our final statement, the statement of cash flows. There is a notoriously tricky compliance rule here that trips up even seasoned accountants during the final chaotic hours of the close. This is a major watch-out area, folks. Under Accounting Standards Update 2016-18, when you present your opening and closing cash balances on the cash flow statement, you cannot just grab your standard unrestricted cash line from the balance sheet and call it a day. Nope. Your cash flow totals must include all restricted cash as well, both current and non-current.
Because of this rule, the final number on your cash flow statement isn't going to perfectly match line 1 of your balance sheet. So GAAP requires a mandated reconciliation note in your disclosures to formally bridge that gap. If we walk through the math, we take the unrestricted cash, add the $50,000 of current restricted cash, and the non-current restricted cash. So while your balance sheet shows $500,000 of operating cash to start the period, your cash flow statement will actually show an opening balance of $650,000 and a closing balance of $750,000. It's a subtle difference, but absolutely critical for compliance.
So, as we wrap up this explainer, I want to leave you with a question to really think about. Take a hard look at your own month-end close. Are you actually segregating the preparer and reviewer? Are you accurately capturing those who-knows-what entries? Properly reclassifying your book overdrafts as liabilities? And most importantly, are you avoiding the restricted cash trap on your cash flow statement? Getting these details dialed in is exactly what transforms a messy, stressful ledger into a completely bulletproof set of financials. Thanks for hanging out with me to untangle all of this, and I'll see you in the next explainer.